What's up YouTube, this is the Working Investor. This video is about fixed rate, risk-free rate people out there and an alternative for risk-free rate. If you're not interested in risk-free rate, then this video will not be beneficial to you. But for those who are in retirement and they want to preserve, capital preservation is very important. Or let's say somebody is saving up for a down payment for a house and they need capital preservation, let's say for about a year or so, and they're looking for a risk-free rate where they have zero exposure to the downside and possibly some captivation on the upside, and they're not interested in the limited amount, let's say, of the treasury products, because remember, this is the 4-week treasury, and you can see here on the bottom, bottom left corner, 927, the rates went down right now. The 4-week treasury is 4.71, 4.79, 4.7% annualized return. And if you go to, let's say, bankrate.com and look for roughly around the, CD high yield savings account, they're about 4.25%. You may get a CD, certificate of deposit, for maybe 4.25, 4.5, I would imagine, if you have to look around. So again, bank accounts are insured by the FDIC insurance. So it's going to be there. Your money's going to be there. And then the treasury products are based by the good faith of the U.S. Treasury. Hopefully, they've never defaulted so far. Hopefully, that keep up their track record. But what about fund that's backed up by a cash secure put, the good faith of a protective put? So not a cash secure put, but a protective put, like a collar method. And this way, these funds, they claim, they have, and I watched the video, they actually had an interview back in May, and I'll link this video in my description, this video in May with the fund manager of Calamos. I'm not sponsored by Calamos, but they do a lot of these buffered products that give you capped upside with zero downside protection. So on 12 main indices. So here you have the October ones coming out, and I'll explain to you that they have basically every month they start a new ETF that basically does options. So for example, their funds, they claim right now coming out October, S&P 500 and Russell 2000, 100% downside protection over 1 year period. And the S&P 500, every month when they open up a new fund for the S&P 500, they have different rates. I guess it depends on volatility, depends on how much premium they collect, how much premium costs, because it's a composition of several options together to create this product for you. So they're claiming it'll be a range of 6.69% to 7.42%. Now, up to, a wise person once told me, when you hear the word up to, it means like a plane is flying from the ground up into the sky. Up to can mean from zero up until the cap limit. It doesn't necessarily mean you're going to get that cap limit. Just bear that in mind. So you have no downside protection. A possible upside capture, if the market goes up, it'll capture, not the full extent of the market, but up to 6.69 to 7.42% of the S&P 500, and the Russell 2000, the ones that are coming out in October, it'll be 8.24 to 9.16%. Their ticker symbols took me a bit to understand. The way I memorized it was they all start with C. C means Calamos, the company. And P is the product, which is like the protective downside product. That's how I think about it. And then the S, the next letter, you see the S, that's for S&P 500. And you see here in the bottom, the R means Russell. So you have the company name, protective product, S&P 500 or Russell. You'll see the third letter will be the S&P S or R. And then the last letter tells you the month. That O is for October. J is for July, T was for September, J was for July. I don't think they had a June one, and M was for May. So that's how you could understand it. And they talk about here they go a little more to depth. So you see it's a 1 year to expiration period. So it's a 1 year period, starts October 1st, coming up this week, and expires in a year from now, to September 30th. The S&P 500, they claim it's 100% downside protection of health through the 1 year outcome period. Their expense ratio is 0.69%. The fund manager is Eli Paris, who has an MBA I think he specializes in finance. I hope he specializes in finance. The benchmarks is the S&P 500, of course. We know what the S&P 500 is. I hope we know that. And the tax application is, they claim that it's tax deferred, and it'll be taxed at long-term capital gain if held longer than 1 year. And here's the same idea with the Russell 2000. We don't have to go through the same thing again. They also have a fund that they call the laddered fund. So you don't have to worry about, because you don't want to, every month the targets could be a little bit different. So the laddered fund gives you, like, a diversification of all different types of months. So you can see you see on top here, it says Calamos laddered S&P 500 structured alternative protection ETF. And you could see here again, they boast the 100% downside protection. And you see here they have the CPS and M for May. That's the S&P 500 May. And you see that starting cap was 9.81%. The video that you're going to see in my description, the link that I'm going to attach, they were talking about the May series. That's why they talk about the 9.81% cap rate. And you see the J for July, which had 9.45% cap rate. They even spell out, like, you see the starting cap was 9.81. That was the maximum you can get. So far, they say that they've captured about 4% of that cap. So they have another, 5.81% of the capitalization of growth you could still get. The current protection level is 94.61%. And they tell you how many days, they spell everything out, how many days it's remaining. And they, like I said, if you hold it for a year, the fund manager said that they'll start the M for May. If you just held it a year, you just forgot about it. But when it comes to next year, May, they'll write new, new options, and it'll be for the next year in May. You can just hold the same fund. It'll restart. It may be a different cap rate based on whatever the volatility is, where the price is that year. So you see July, you could see August, the cap rate 8.74, September 7.75. So yeah, so this gives you an idea. So the laddered fund, I guess, gives you a little bit of a composite of a bunch of funds. So you don't have to worry about being tied into a certain cap. Here are my notes that I took from the interview, and you can watch the interview yourself. So basically from the interview, they said they want to do 12 large broad index ETFs. That's their goal they want to do. You already know the 100% principal protection with upside, capped upside, hence the call. It's 1 year expiration options. They use the flex options. He mentioned there are no dividends, but he mentioned something with a pass-through dividends. I wasn't sure exactly, so you have to look into that. It's very convoluted to find the prospectus. I'm still digging through it. It's been quite some time going through all this. You're welcome. They say it's tax efficient and liquid. The guy gives an example. Let's say you buy into the fund $100. I still need to work these out. So he says you buy, this is the protection. The at the money put that you purchase, it's a protective put. Think about a collar method. It's a collar method is a strategy people use in options to protect your downside. And then you sell an out of the money call. So that's a -2 because you received premium. And then you buy a deep in the money call. So the $98 plus $4 is 102, minus 2 is 100. So there's your $100. So I was trying to replicate this in the S&P 500 or in the SPY. I mean, I wasn't able to perfectly figure out a way that made sense, but I could show you an example of a collar method. And before we get to the collar method, let's look at the chart from their CPSM, the May series. Look at this May series. Look at this chart. Look at that beautiful chart. You bought this product for $25 a share. It's 26.41. You do see it does dip down. They say that the protection is if you hold it until the end. Of course, August 5th, it did dip a little bit. And then there was a little dip in September as well, beginning of September. But overall, this is a beautiful portfolio. It looks pretty nice, this chart. Somebody who is nearing retirement, they need to have their asset protection, then they would like this. Also to mention, when I showed you before the CDs, I'm not sure if I mentioned it or not, the CDs and the treasury products, they're also the risk-free rate. But when you see those 4.7 something percent in the T-bills on the treasury products, or the 4.25% in the high yield savings account rate, at least you know exactly what rate you're going to get. Here it can go it's risk-free, but it's unguaranteed. If you do a certificate of deposit, you're locked into that rate, so you're kind of, you know exactly what you're going to get minimum. Let's look at the S&P 500. Let me show you a example of a collar method. So hypothetically, let's say we wanted to do, this is not how they do it, but this is just an example. If you went out to about a year from now, let's go, there's some volume, mid-September of 2025, September 19, 2025, almost a year out. So let's say you do a buy put. So right now, let's say you own 100 shares of SPY. And right now, as you can see here in the middle, SPY is trading for $570.67. So you buy a put at 570. So when you buy this long put at 570, it's a protective put. That means that you whatever further down SPY goes, you're just gonna protect you from the downside. But you're spending $29.15 to buy this put. But you could sell a call for around $29. Let's look for $29. So we see here 29.03. So let's say you go 31 to get a little extra premium for $31, right? So now you selling a call and you have a net credit of $2.71 per share times 100 shares, $271 credit. So now you basically have 100% downside protection. So your equity of, $57,000 is protected 100% by the put. And your put was for free because the put was offset by the call. But now the maximum you can make is from right now is trading at 570. Let's call it 570. It's a little more, some change more. And your maximum you can make is 595, which was the strike price of your short call. But then, so that's $25 that you can make maximum in a year. You're capping your upside. Plus, don't forget, you are receiving a net credit of $271. So if you did, basically, $25 plus the 2.71 in credit, right? That's 27.71 divided by the price right now, 570. Whoops, 570, roughly. So that comes out to be times 100. So you get to enjoy a 4.86% upside. But wait, there's more. The S&P 500, don't forget, does have a little bit of dividends, but we got to add that in to get your total return. So if you go to here, I think I saw 1.22%. So S&P 500, has about a 1.22%. So you basically, your total return would be 4.86 plus 1.22. So what I'm trying to say is, I know this is not really a sexy return from these high yield dividend funds, but getting a 6% return, let's say you own the S&P 500 and let's say, it's $57,000 you have invested for the 100 shares of SPY. And let's say you want to put a down payment on a house, or you just have, you don't want to lose that capital. For whatever reason, you just want to keep it like, you want to just for a year, you just want to keep it, out of market risk. And you don't want to sell it for, let's say, for example, because at this moment, because you don't want to, take capital gain, tax or something like that. So you could just do the collar method, and now you get the $271 and you get to enjoy this, this up to, you capped your upside to 6.08%. So you have no downside risk and you have a potential to make a maximum of 6.08%. Of course, this is not on the flex option exchange. So if your strike price does go beyond, your short call, you could get your shares called away in the middle of the year but then you'll just tap out and you'll be back to cash, but you'll be 6% more than you started. So there is that risk. Flex options, that doesn't happen. So anyways, let me know what you guys think about this interesting alternative to the risk-free rates. This is The Working Investor, over and out. Have a wonderful weekend.